The U.S. markets are currently closed. As of the final closing bell on Friday, November 21, 2025, ACHR Aviation, ACHR, finished the session trading at exactly $7.17 per share. We saw a distinct intraday push, closing up approximately 4.37% on the day, with after-hours action inching slightly higher to the $7.21 level. That green candle on Friday isn't just noise. If you are looking at the surface-level chatter on individual brokerage platforms like Robinhood or skimming the headlines on your Fidelity mobile app, you might think this is just another volatile day for a speculative, flying car stock. The expectation, the narrative that has been fed to retail investors for 2 years is that ACHR Aviation is a binary bet. You either believe they get FAA certification and we all fly to work like the Jetsons, or they run out of cash and go to zero. That is the expectation, a high-stakes, all-or-nothing regulatory gamble. But here is the reality, and it is something the casual crowd on SoFi Invest is completely missing right now. ACHR Aviation just fundamentally altered its DNA. They are no longer just an air taxi operator waiting for a rubber stamp from the government. With the recent strategic shift we have seen in the last few days, specifically regarding the supply deal with defense contractor Anduril, ACHR has quietly morphed into a critical aerospace supplier. They aren't just selling rides anymore. They are selling the engine, literally. They are pivoting to a model where they monetize their proprietary tech before a single passenger buys a ticket. This changes the entire risk calculation. If you are holding ACHR stock or thinking about adding it to your Schwab Intelligent portfolios, you need to understand that the company you bought yesterday is not the same company that exists today. Let's look at the tape. Friday's move to $7.17 came on significant volume, pushing well past the 50-day moving average. This kind of price action often signals institutional accumulation, likely triggered by the aggressive price target hike we saw from analysts at Canaccord Genuity, who just slapped a $13 target on the stock. That implies nearly 80% upside from where we are sitting right now. But why the optimism? The catalyst is the Omen project. This is the wedge that separates the old ACHR from the new ACHR. ACHR announced they are supplying their electric powertrain technology to Anduril Industries, the defense tech unicorn founded by Palmer Luckey, and the Edge Group for a new autonomous aircraft called Omen. This is massive. Anduril is not just another contractor, they are the premier disruptor in modern defense. By integrating ACHR's battery packs and electric engines into military-grade autonomous drones, ACHR has secured a revenue stream that does not depend on the FAA certifying a passenger-carrying aircraft immediately. Think about what that means for your online investment strategy. Usually with pre-revenue companies like this, you're sweating every single quarter, watching the cash burn like a hawk. But now, ACHR has validated its technology with the military-industrial complex. This is dual-use technology in action. It validates the engineering. If the powertrain is good enough for a tactical autonomous vehicle in a conflict zone, the safety case for commercial flight becomes that much stronger. However, we have to address the bear case immediately because it is fierce. While the bulls are celebrating the Anduril deal, we saw a massive exit from Heights Capital Management, who completely liquidated their position recently. When a major fund walks away, you have to ask why. They likely see the cash burn, which is still significant, as a hurdle that even defense contracts can't fix overnight. ACHR is still spending money rapidly to build out their manufacturing facility in Georgia. Let's break down the intraday dynamics we saw leading into the weekend. The stock opened at $6.88, dipped to a low of $6.55, where it found hard support, likely algorithmic buying programs kicking in at that psychological $6.50 level, and then ripped higher into the close. That ripped into the closing bell is a classic bullish signal. It tells us that traders did not want to be short over the weekend. They were afraid of missing news. If you are using a Fidelity trading platform or perhaps interactive brokers to track your order flow, you probably noticed the options activity. Call buying has been picking up, specifically for strikes out in early 2026. This aligns with the commercialization timeline. The smart money is starting to position for the actual launch of the Midnight aircraft. Speaking of the aircraft, let's get technical. The Midnight is not just a helicopter with batteries. It uses a proprietary 12-tilt, 6-propeller configuration. 6 propellers spin for vertical lift, and then the front 6 tilt forward for cruise flight. This is aerodynamically difficult to achieve. The fact that they are now licensing the guts of this system, the powertrain, to third parties is the Intel inside moment for EVTLs. Most people looking for online investing help or browsing investing sites for tips get hung up on the flying taxi service. They imagine booking a flight on their phone like an Uber. Yes, that is the end goal, but the bridge to get there is manufacturing. ACHR has partnered with Stellantis, the giant behind Jeep and Ram. This is not a paper partnership. Stellantis is pouring hundreds of millions into ACHR and actually helping them build the factory. This separates ACHR from competitors like Joby Aviation or EHang. Joby is vertically integrated, trying to do everything themselves. ACHR is leveraging the automotive supply chain. It's the difference between building a car by hand in a garage versus building it on a Ford assembly line. Let's pause on the financials because this is where the expectation versus reality tension is tightest. Expectation: ACHR is bleeding cash and will dilute shareholders to death. Reality: they are sitting on a fortress balance sheet relative to their peers, with over $1.6 billion in liquidity. This includes recent capital injections. In a high-interest rate environment, cash is oxygen. Many EVTL competitors have less than a year of runway left. ACHR has enough cash to get them deep into the certification phase. But you cannot ignore the dilution risk entirely. They have an equity line of credit and they have used it. If you are an individual brokerage investor, you know that secondary offerings kill momentum. Every time the stock pops, management might sell shares to raise more cash. This acts as a ceiling on the stock price. That is why the $7.50 to $8 level has been such a stubborn resistance point. We need to see a high-volume breakout above $8 to confirm that the downtrend is truly over. Comment below right now. Do you think the defense sector revenue will be enough to stop ACHR from diluting shareholders again in 2025? I want to see your take, yes or no. Now, let's look at the competitive landscape. Joby Aviation is the primary nemesis. Joby recently filed a lawsuit against ACHR alleging patent infringement and theft of trade secrets. This is ugly, but it is also a sign of maturity in the sector. You don't sue a company that doesn't matter. You sue the threat. Joby is widely considered the leader in certification, but ACHR's rapid catch-up has clearly rattled them. If you hold Joby stock in your Robinhood Investments account, you are watching this lawsuit closely. If ACHR wins or settles for a small amount, it removes a massive overhang. If they lose, it could be catastrophic. This is a binary legal risk you must factor in. We also need to talk about the route strategy. ACHR isn't trying to fly everywhere. They are targeting trunk routes. Think Manhattan to Newark Liberty Airport, downtown Chicago to O'Hare. These are high-friction, high-value routes where business travelers will happily pay $100 to save an hour of traffic. They have already locked in United Airlines as a key partner and customer. United has placed a provisional order worth $1 billion. Again, compare this to the Uber of the skies fantasy. Archer is building a premium airport shuttle first. That is a manageable business model. It is not trying to replace your car, it is replacing the black car service. If you are using SoFi Active Investing or perhaps managing your own funds through a Fidelity IRA, you need to look at the macro picture. The Federal Reserve is signaling potential rate cuts. Growth stocks, specifically speculative tech stocks like Archer, are incredibly sensitive to interest rates. When rates are high, the future cash flows of Archer, which are years away, are worth less today. When rates fall, those future cash flows are discounted less, and the stock price goes up. We are entering a potentially favorable macro cycle for Archer just as they are hitting their technical milestones. Let's go deeper into the Anduril partnership, because I don't think the market has fully priced this in yet. Anduril is building the arsenal of democracy with autonomous systems. By being the powertrain supplier for the Omen platform, Archer effectively outsources its R&D costs for battery ruggedization to the defense budget.